All right, so we're all about securing that financial future, right? And today we're diving deep into long-term investments, the strategies you need to make your money grow, over time.
Yeah, absolutely. Making your money work for you. So you're not, constantly chasing that next paycheck.
Exactly. So many options, though. What if I'm feeling a bit adventurous, ready to hit the gas pedal on my investments?
Well, in that case, you might want to look into growth stocks.
Those stocks.
Like think Tesla or maybe one of those cutting-edge biotech companies.
Oh, okay.
Yeah, they're all about rapid expansion. They reinvest their profits so they can keep innovating and grab, bigger chunks of the market share.
Sounds exciting, but also a little risky.
Well, there's definitely a risk-reward element there. High growth potential, high risk.
Right. So what red flags should I be watching out for?
Well, first look beyond the hype.
Beyond the hype, okay.
Yeah, is the company actually making a profit or are they just burning through all that investor cash?
Good point.
And do they have a competitive edge, something that they can, sustain for the long haul?
Okay, so basically do your homework.
Exactly. Due diligence is key.
Makes sense. But what if I'm not comfortable picking individual stocks? I'm more of a set it and forget it kind of investor.
Gotcha. Well, in that case, stock funds might be a better fit.
Stock funds.
Yeah, you can think of them as a basket of stocks.
Yeah.
Carefully chosen, of course, to represent a specific theme. Could be, large American companies or maybe renewable energy companies.
Okay, I'm listening.
So you're basically getting a slice of that whole sector without having to pick and choose each individual stock.
So less work, good diversification.
Exactly.
Awesome. Any suggestions for a newbie?
Sure, I'd recommend checking out index funds.
Index funds?
Yeah, they track a specific market index, like the S&P 500, for instance.
Well, I've heard of that.
Yeah, so you're basically owning a tiny little piece of the entire American economy with that.
That's pretty cool.
Yeah.
Okay, but switching gears a bit, what about investments that are, a bit more steady, like something that generates income instead of just growing in value?
So you're thinking about bonds.
Bonds, right.
Basically, it's like giving a loan to a company or even the government. They use your money, and in return, they pay you interest.
Like a steady paycheck, right?
Yeah, exactly.
But isn't putting all your money into a single bond kind of risky? I mean, what if that company, goes under?
That's where bond funds come in.
Bond funds, okay.
Similar to stock funds, they spread your investment across a bunch of different bonds, diversifying, mitigating the risk.
Okay, so less risk.
Yeah, and you can even choose funds based on your risk tolerance.
Yeah.
Government bonds are generally considered the safest.
Makes sense. So safer, but probably lower returns, right?
Well, yeah, usually.
Okay, so if I wanted higher returns with bonds, would I go for corporate bonds?
You could, yeah.
But how would I know if those companies are, a safe bet?
You'd look at their bond ratings. Think of them kind of like credit scores for companies.
Oh, okay.
Yeah, agencies like Moody's and Standard & Poor's, they look at the financial health of these companies and then assign a rating. The higher the rating will lower the risk, but that usually means a lower potential return as well.
So I can mix and match within my bond fund, some safer government bonds, maybe some riskier corporate bonds for a potentially higher return.
You got it. All about finding the right balance for your risk appetite.
Okay, got it. Now back to stocks for a sec. What about these dividend stocks? I hear they actually pay you just for owning them. Is that for real?
Oh, yeah. Dividend stocks are definitely a thing.
So how does that work?
It's basically shares of companies that are already, well established and bringing in good profits. Instead of reinvesting all that money back into growth, they share a portion with their shareholders as dividends.
So like getting paid to be a part owner, are we talking about like older, well-known companies?
Huh? Yeah, often, yeah. Think Coca-Cola or Johnson & Johnson. Companies that have been around forever got a solid track record.
Reliable ones, okay.
Exactly. And they're happy to share the wealth with their investors.
But are all dividend stocks like created equal? Is there a way to tell which ones are going to be more reliable?
Oh, absolutely. Look for companies that have a history of not just paying dividends, but also consistently increasing them over the years. Those are the dividend aristocrats.
Dividend aristocrats. I like the sound of that. Okay, so let's shift gears again. What about companies that people seem to be sleeping on? The hidden gems, the ones with untapped potential.
You're talking about value stocks.
Value stocks.
Yeah, companies that, for whatever reason, are undervalued by the market. Maybe they hit a temporary snag. Maybe they're in an industry that's not so hot right now.
I see.
Or maybe the market just hasn't quite caught on to their true potential yet.
So it's like finding a designer item at a thrift store, right?
Haha, kind of. All the quality, but at a bargain price.
Love that. But how do you even know if a company is genuinely undervalued or if it's just, not doing well for a reason?
Well, you got to analyze the company's fundamentals. Look at their earnings, their debt, their management team, the whole picture.
I see.
Are they financially sound? Do they have a solid plan for the future?
Okay.
If the answers are yes, but the market price is still low, well, then you might have stumbled upon a hidden gem.
Makes sense. But this is getting kind of deep.
Well, yeah, value investing often requires a bit more research, more familiarity with financial statements.
What if I'm just, a big picture person?
Yeah.
I want to invest for retirement, but I don't want to spend every weekend hunched over spreadsheets.
Have you ever considered target date funds?
Target date funds, what are those?
They're specifically made for retirement savings. They handle all that complicated asset allocation stuff for you.
Really?
Yeah, you just pick a fund that's aligned with your expected retirement year.
Okay.
Then the fund managers will automatically adjust the mix of stocks and bonds as you get closer to retirement.
So it starts out more aggressive early on and then gradually gets more conservative.
Exactly.
Like a financial autopilot.
Pretty much. Takes you right to your destination.
That's awesome. All right, let's take a break from the stock market for a second, talk real estate. That's a classic investment, right? But is it all it's cracked up to be?
Real estate can be great, yeah, for building wealth, but it definitely comes with its own set of challenges.
Like what? What are the potential downsides?
Well, first off, it requires a pretty hefty upfront investment.
Right.
Down payment, closing costs, property taxes, you name it, it adds up fast.
Right.
And real estate isn't exactly liquid, It can take a while to sell a property.
True.
Plus, you might not get the price you were hoping for.
So, not a quick way to get rich, that's for sure. Anything else to be wary of?
Yeah, property management can be a real headache.
I can imagine.
Dealing with tenants, maintenance, unexpected repairs, It's not for everyone. And then there's the market itself.
The market, okay.
Prices can fluctuate, just like with stocks.
So you could end up losing money.
You definitely could. It's not as simple as just buying a property and watching the money roll in,
Got it. It's a lot more hands-on than people think. Okay, so say I'm comfortable with those risks, and I want to branch out beyond, the typical stocks and bonds. What about those smaller companies, the ones just starting out that could, explode in value?
You're talking about small cap stocks.
Small cap stocks, right.
Yeah, these companies have smaller market capitalizations, meaning their overall value is lower compared to those big, established corporations.
So why would I invest in a smaller company? Wouldn't that be riskier?
It can be riskier, yeah, but that higher risk often comes with a higher potential for reward.
Ah, okay.
Small cap stocks have more room to grow. They can expand much faster than those large cap companies. Think about Amazon. Back in the day, it was a small cap stock. Look at it now.
So it's like betting on the underdog, hoping they become the next big thing. How do you even evaluate those, though? There must be thousands of small cap stocks out there.
Thousands, absolutely. It takes more research, a higher risk tolerance for sure. Look for companies with a strong management team, a unique product or service, and a really solid plan for growth.
So it's about finding those hidden gems with real potential. I don't know, that sounds pretty overwhelming. What if I went in on small cap stocks, but I just don't have the time or the know-how to sift through all of them?
Well, that's where robo-advisors come in handy.
Robo-advisors, huh?
Yeah, they use these sophisticated algorithms to create and manage diversified portfolios based on your goals, your risk tolerance, all that.
So like a personal financial advisor in my pocket.
You got it.
Cool. But without the hefty fees, I hope.
Right. Usually much lower fees.
Yeah.
Most charge a small annual fee based on a percentage of your assets under management.
Sounds convenient.
Yeah. And you can usually access your account, check on your investments online, or even through an app on your phone.
All right. So before we wrap up this section on investments, got to talk about something I keep hearing about.
Yeah.
Roth IRAs. Everyone says they're amazing for retirement savings. What's the big deal with those?
So the Roth IRA is really powerful for long-term savings. It all comes down to those tax advantages.
And tax advantages? Okay, I'm all ears.
So you contribute after-tax dollars. You've already paid your taxes on that income.
Right.
But then, get this, the earnings on your investments grow tax-free.
Tax-free, okay.
And when you withdraw the money during retirement, you don't owe any taxes on it either.
Wait, so no taxes on the growth A&D? No taxes on withdrawals?
Yep. That's the beauty of the Roth IRA.
Wow, sounds almost too good to be true.
Especially helpful if you think you'll be in a higher tax bracket later in life, during retirement.
Okay, so starting early is key.
Absolutely. The earlier the better. Gives your money more time to grow tax-free.
Okay, we've covered a lot of ground here. Growth stocks, bonds, dividend aristocrats, even value investing. It's a lot to take in. What are some key takeaways for our listeners as they start their own investment journeys?
Well, I'd say first and foremost, understand your risk tolerance.
Risk tolerance, right.
How much volatility can you stomach? How much potential loss are you okay with, in exchange for those potentially higher returns?
That's a good point.
Once you have a handle on that, you can start building a portfolio that, aligns with your comfort level.
So finding that sweet spot between playing it safe and taking a few calculated risks. What else should our listeners be thinking about?
Definitely don't underestimate the power of time.
Time, okay.
The sooner you start investing, the better. Even small, consistent contributions over time can really add up to something significant down the road.
It's a marathon, not a sprint, right?
You got it. Patience and discipline are key here. Don't get spooked by those short-term market swings.
Great advice. Okay, and I got to ask about diversification. It's like the golden rule of investing, right?
Yeah.
But what does it actually mean in practice, and why is it so important?
So diversification is all about not putting all your eggs in one basket.
Right, classic advice.
By spreading your investments across different asset classes, you're basically reducing your overall risk. So if one investment takes a hit, the others can cushion the blow, so to speak.
So it's like a safety net for your portfolio.
Precisely. And in practice, it can be as simple as having a mix of stocks, bonds, maybe some real estate, or you can get even more granular, diversifying within each of those asset classes.
So like within stocks, I could have some large cap, some small cap, maybe some international stocks too.
Exactly.
It's all about building a well-rounded portfolio, something that reflects your goals, your risk tolerance, all that.
You got it. A portfolio that's tailored to you. Yeah. It's like, building a house. You wouldn't want it to be made entirely of glass, right? Needs a strong foundation, solid walls, and then maybe some, decorative touches to make it your own. Same goes for your portfolio. A good mix helps you ride out those financial storms.
I like that analogy. But okay, so many investment options out there. It's kind of overwhelming. Where do you even start building that diversified portfolio?
Well, it starts with understanding what you're actually aiming for. What are your financial goals?
Goals, okay.
Yeah, you saving for retirement, a down payment on a house, maybe that dream vacation you've always wanted.
Makes sense.
Once you've got those goals in mind, then you can start tailoring your investment strategy.
So like if I'm saving for retirement, which is decades away, I could probably be a bit more aggressive with my investments, right?
Exactly. More time to recover from those market ups and downs.
But if I'm saving for a short-term goal, like a vacation next year, I should probably play it a bit safer.
Yeah, exactly. In that case, you might lean more towards those conservative investments like bonds or even just a high-yield savings account.
Right, okay, that makes sense. But there's still a lot of confusion out there about, like, how much risk is appropriate. Any tips for figuring that out?
Well, there's a good rule of thumb. Subtract your age from 100. And that number, that's roughly the percentage you could put into stocks.
Oh, interesting.
So like if you're 30, you could aim for around 70% stocks and 30% bonds.
Okay, that's a good starting point.
Yeah, remember, it's just a guideline. You can adjust it based on, how comfortable you are with risk and what your specific goals are.
Gotcha. But let's be real, investing isn't just about numbers. It can be pretty emotional, right?
Yeah.
Especially when the market takes a dive. How do you, keep a level head when things get shaky?
That's one of the toughest parts, for sure. Keeping those emotions in check, especially when fear or greed starts creeping in.
It's easy to panic, right?
Oh, absolutely. Most people want to sell when the market drops and then buy when everything's sky high. But that's usually the worst thing you can do.
So resist the urge to panic sell. Got it.
Exactly. Remember, it's a long game. Successful investors, they're the ones who stay focused on those long-term goals, even when things get bumpy.
So having a plan helps, right? Staying disciplined, even when it's tough.
Absolutely. Having a solid plan helps you stay the course.
Okay, so what does a good investment plan look like? What should our listeners be thinking about?
Well, first, define your financial goals. Really think about what you want to achieve with your investment.
I touched on that a bit, yeah.
Is it retirement? Buying that house? Maybe starting a business? Once you know what you're aiming for, you can figure out how much you need to save and how long you have to reach that goal.
Like a roadmap, right?
Yeah, exactly. Then, gotta assess your risk tolerance. We talked about that earlier.
Right.
How much are you willing to risk? How much could you potentially lose without, completely freaking out?
And it's okay to be more on the cautious side, right?
Absolutely. Better to sleep soundly at night knowing your investments are aligned with your comfort level than to be constantly stressing about, every little market dip.
That's a good point. So, okay, we have our goals, our risk tolerance. What's next?
Asset allocation. That mix of stocks, bonds, and other investments.
Diversification.
Right. It's like building a balanced meal, making sure you get all those essential nutrients. You want your portfolio to be, healthy and strong, too.
So a mix of assets is key.
Exactly. And the specific mix, well, that depends on your goals, your risk tolerance, your time horizon, all those things we talked about. And hey, don't be afraid to talk to a professional if you need help with this part.
It never hurts to get some expert advice. What about choosing specific investments? Any tips for our listeners who might be feeling a bit lost in the sea of, stocks and bonds and mutual funds and all that?
Do your research. Don't just, blindly follow some hot stock tip you saw online. Look into the company, check out their financial statements, see what the analysts are saying, really understand those risks.
Okay.
And remember, index funds and those target date funds we talked about, those can be great choices for people who want a more hands-off approach.
So make informed decisions.
Yeah.
Got it. But even with the best plans, sometimes things don't go as expected, right? The market dips.
Yeah.
Some investments don't perform well. How do you deal with those setbacks?
Well, that's when you need to lean on those good old-fashioned virtues, patience and discipline.
Right. Stay the course.
Don't panic and sell everything just because the market's down. Remember, long-term investing, it's like sailing a ship. You're going to hit some rough waters now and then.
And ride those waves. Don't jump ship.
Exactly. And that's where the power of compounding really comes in.
Oh, yeah. Compounding. What was that again?
It's basically earning returns on your returns. Over time, it can make a huge difference.
Okay, so the longer you stay invested, the more you benefit from compounding.
Right. Think of it like a snowball rolling downhill. Start small, but just keeps getting bigger and bigger.
That's a great image. Okay, I want to circle back to something we touched on earlier, robo-advisors. They seem like a really great option for, anyone who's new to investing or just doesn't have the time to manage their own portfolio. Can you break it down for us? How do they work?
Sure. So robo-advisors, they're basically online platforms. They use algorithms like fancy math formulas to build and manage investment portfolios for you.
Based on your specific needs, right?
Exactly. They're a great way to dip your toes into investing because they take care of all the, complicated stuff like asset allocation.
So you don't have to pick individual stocks or anything?
Not necessarily, no. The robo-advisor does it all for you. And it's usually way cheaper than hiring a human financial advisor.
That's a big plus. So what should you look for when choosing a robo-advisor? What are the key differences?
Fees are a big one. You want to make sure they're transparent and competitive.
Okay, low fees, got it. What else?
Then check out the investment options. Do they have a good selection of assets? Stocks, bonds, maybe even some alternative investments like real estate.
Makes sense. So the platform should align with, your investment goals and how much risk you're comfortable with.
Exactly. You want to make sure their investment style is a good fit for you. And some robo-advisors, they offer cool extra features too, like tax loss harvesting.
Ooh, what's that?
It's a strategy that can help reduce your tax bill. And some also do automatic rebalancing, it keeps your portfolio on track.
So it's not just a one-size-fits-all thing.
Yeah.
There are different robo-advisors out there.
Oh, yeah, definitely. Do your research, find one that fits your needs. And remember, even with a robo-advisor, you're still the one calling the shots. It's just a helpful tool. It's not going to replace, your own judgment.
That's a good point. You're still in control. We've talked about different options, strategies, but ultimately, maybe the most important investment is in yourself.
100%. I'm talking about investing in your financial literacy.
Financial literacy.
Yeah, take the time to learn about this stuff. Read books, maybe go to some seminars, follow some good financial news sources.
So the more you know, the better decisions you can make.
Exactly. The less intimidating investing becomes, the more confident you'll feel making those decisions that align with your goals.
Knowledge is power, as they say. And it's okay to ask questions along the way, right?
Oh, absolutely. Don't be afraid to ask for help if you don't understand something.
Right.
Talk to a financial advisor, a friend you trust, or look up some reputable info online. No shame in admitting you don't know everything, Actually, it's pretty smart to be willing to learn.
So it's a journey, right? This whole financial learning thing, it's ongoing.
Exactly. It's about empowering yourself, taking control of your financial future, building the life you want.
This has been so insightful. We've covered so much ground. From the basics to some really interesting strategies. I think our listeners are going to be well equipped to, start taking action, to start building their own path to financial success. It's funny, as we're talking about all these different ways to invest for the long term, kind of reminds me of life in general.
How so?
Well, taking calculated risks, planning for the future, riding out those tough times. It applies to, finances, A&D, just navigating life in general.
That's a great point. We often think about money as this separate thing, but it's really connected to everything, isn't it?
Totally. Our finances impact, our freedom, the choices we can make, even our ability to pursue our passions.
Yeah. It's all about aligning your money with what you value, with what you want your future to look like. But I think a lot of people feel kind of stuck, like they don't know where to even begin.
It can be really overwhelming, for sure.
Yeah, especially with all the information out there. But remember, it's not a race, it's a journey, right?
Yeah.
Start small, educate yourself, and just build those good habits.
Like making a budget, tracking your spending, putting a little aside each month.
Exactly. Those little things, if you do them consistently, they can really make a difference over time.
Yeah, like the saying goes, the journey of 1,000 miles begins with a single step. But sometimes I think we get so caught up in the how of investing that we forget the why,
That's so true. It's easy to lose sight of the bigger picture. Why are we even doing this? What are we hoping to achieve?
Yeah, what's it all for?
What does financial freedom look like for you? Early retirement, travel, starting a business, having that security to chase your dreams without constantly worrying about money.
For me, I think it's about having choices, the freedom to say yes to things that matter to me, to spend time doing what I love.
I love that. And I think that's what it's all about, creating a life with more abundance, more possibilities.
Not just about hoarding money, but using it as a tool to live a better life.
Exactly. A more fulfilling life, a life with more purpose. And I think that's a really empowering message for our listeners.
It is. So as we wrap up this deep dive into long-term investments, I want to leave everyone with this. What if the biggest risk is not investing in yourself, in your dreams?
Wow, that's powerful, because at the end of the day, it's not just about those financial returns, it's about your return on life.
Investing in yourself, your experiences, building a life that's both financially secure and, truly meaningful.
Well said. Thanks for joining us on this journey into the world of long-term investing. Remember, it all starts with that first step, and with a little knowledge, a little courage, you can build the financial future you deserve.
Absolutely. Until next time, happy investing, everyone.